So Google abandons building 15,000 much-needed homes in the San Francisco area. That's a shame. It certainly is. That and more. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is November the 7th. Randy Patrick here, putting the realism back in real estate. Hope you're doing well. I was supposed to commit to doing a video a day. Let me tell you, did my video, the first one in a couple of months, the other week, I think it was Wednesday, and I was out in the field on Thursday, and something bad happened. I picked up the worst stomach virus I've had in years, and I was in the field being sick and was knocked flat on my butt for the past few days. So I'm just getting back in the swing of things yesterday and today. So we'll be catching up here. Stuff is going so fast. A lot of things going on here in the real estate industry. It's like every day there's so many articles, so many things to talk about. It's ridiculous. But here is the scoop. This is interesting. But first of all, if you happen to be in the Tampa Bay area, we're launching, so the group I'm involved with, we're launching a new brokerage firm out of the sort of collab incubator space that we work in now, called Real Freedom Collab. So it's the Real Freedom Realty launch party. It's tomorrow night, Wednesday, November the 8th, at the Real Freedom Collab. There's the Eventbrite down there, or you can just text me or email me and I'll send you the link. Basically, we got a couple people who are speaking on the panel, and I'll be the guest speaker. We're basically launching a new brokerage firm, really designed to serve the investor community, do the cool things that we do. So having said that, if you can make it, love to see you there. Drinks and appetizers and networking and some fun. All right. So anyway, Google abandons building 15,000 homes in San Francisco. So very interesting article. And so Google's not the only company that's sort of committed to doing this. I know Tesla has done this in Texas and a couple other companies here and there. The whole point they're trying, is like, hey, let's see if we can use our buying power and our, obviously our enormous wealth and market capitalization to do something for our employees to keep them in place, et cetera, et cetera. So, this was a thought that was sort of structured back in 2019 to develop housing and commercial space in Sunnyvale, San Jose, and Mountain View. Obviously, it's the home for the tech giant. And it was a $15 billion investment in Santa Clara County. Well, they pulled out of it. They would have built 15,000 homes. Basically, that's the situation. They're giving up on the city. That's just their perspective, I guess. So it's difficult trying to make ends meet and pull that off in the greater San Francisco, probably San Jose area. So the Downtown West project in San Jose was set to feature 4,000 affordable housing units, sufficient office space for 20,000 workers, a 300-room hotel, and 10 parks. Instead, it's getting nothing. All right. So the problem we see is this is affecting certain locations across the country. So obviously, in locations where it's enormously high priced for homes and rent, taxes, where you've got high crime, drug use, other issues going on in the streets of that location, probably not as welcoming as they thought it was back in 2019. That's the situation kind of we're in right now. So basically, it's like, what do you do, right? So they're pulling out of it. And don't forget, that was 2019, before COVID was around. So workers were there, workers were around their home bases, their offices, etc. Well, now we've got locations or telework, and we've got people working from home, and the whole COVID phenomena. People sort of relocated, doing work virtually. So I can see, I would imagine that the need for all these housing units to support their office workers has probably dwindled, let alone the cost of financing that, et cetera, et cetera. So the market changes. I mean, again, we're in 2023 now, and then they were talking about this about 4 years ago. So things do change. So it is a bit of a shame, because I'm sure it's much needed housing, but it goes to show you how much the real estate market has changed over the years, how price for materials, how prices escalated and skyrocketed over the the COVID timeframe, how interest rates now, so the cost of borrowing money, the cost of acquiring money, utilizing money is much higher than it was. The returns are just probably not there. So this should not come as a surprise to anybody, and I'm betting we're going to see more and more companies that have already committed to doing stuff like this probably either changing their tune, pulling out completely, or maybe reducing what they had kind of promised. So basically, in 2021, the San Jose City Council gave the green light for the project. And basically, the progress was halted in April during the demolition stage, leaving its future uncertain and potentially becoming a blight on the San Jose landscape at a time when economic injections are sorely needed. So a lot has happened in that area. You've had the Silicon Valley Bank implosion, stuff like that. So there's probably a lot of underlying factors that have contributed to this. But again, you've got a lot of problems in that area with respect to social issues, what's going on in the downtown cores, what people see when they walk around. The downtown cores are virtually, ghost towns these days. Businesses have moved out, fast food has moved out, retailers have moved out. So it's pretty sad, but this is what happens. And as they say, they're optimizing their real estate investments in the Bay Area, looking for options to move other development projects forward to deliver on our housing commitment. But what they had planned on the big splash is not going to really happen. So sad to say that, those are needed housing units, but this is what happens in today's market. And folks, if you appreciate the information I provide on the channel, if you could do me the honor and subscribe, that'd be great. Also, if you think you're a subscriber, please verify your subscription and hit that bell notification, because for whatever reason, I lose subscribers all the time. So thank you very much. Now, to sort of add to that, well, this week WeWork, once valued at $47 billion, filed for bankruptcy. So if you remember, WeWork was an office sharing company back in the day. When it first came out, it was touted as this great concept, and they were, leasing wonderful spaces in major cities across, North America, U.S., Canada, the world, whatever. Well, again, it filed for Chapter 11 protection on bankruptcy on Monday, valued in 2019 at $47 billion, by SoftBank, VC, funding. Company tried and failed to go public 5 years ago because it was found that there just wasn't enough guts to what was happening there. It disclosed in August regulatory found that the bankruptcy could be a concern, and guess what happened? It really did. So essentially, it entered agreements with majority of its secured note holders that it intended to trim non-operational leases. The bankruptcy filing is limited to WeWork's U.S. and Canada locations. It has a total debt of $18.65 billion against a total asset of $15.06 billion in the initial filing. So basically, it's over leveraged for sure. Again, this, and I've read about this over the past few years, suffered one of the most spectacular corporate collapses in recent U.S. history because of the valuation when it came through. Its venture capital round initially. The company tried to go public, it failed. This is where you think that COVID would have maybe helped, but it didn't, because again, if they were the ones that were hosting office locations for various corporations and tenants and leases and across major cities, and COVID hits and all their people in those leases go, hey, I'm going to work from home. Well, guess what? They suffered and they never recovered, and it's a trickle down effect. So this is what happens when stuff like that sort of hits the marketplace. So basically, WeWork has lost 98% of its value, if you can believe that. It announced a 1-for-40 reverse stock split of its shares, trading back above $1. That was the whole idea. WeWork shares have fallen to a low of about 10 cents and were trading at about 83 cents before the stock halted Monday. So the former CEO and founder said the filing was disappointing. I'm sure it is. But again, this is yet one more sort of blight on the real estate market. Granted, this is the commercial real estate market, but it goes to show you how precarious the market is right now. The commercial market, which I don't talk about too often, but we're getting involved in quite heavily on our end here, besides the residential stuff. I mean, it's posed for major collapse. The issue with the commercial market is all their financing is coming due. 2.25 to 2.75 trillion of notes are coming due over the next 5 years. And guess what? When all these companies got their leases, bought their buildings, made their hotels, got all their warehouses and self-storage, whatever, they got great 2.75, 4% type interest rates on their loans. Well, if they're going to, if those loans are now expiring, balloon payments are due, and they need to refi and reset, well, when you're at 7-8%, that changes the dynamic of the marketplace and what you're paying out, what you're taking back on your balance sheet. That's causing problems. So this is the start of many more larger corporations and smaller landlords or lease or owners of commercial property. We're going to see a big carnage coming up. So, but the trickle-down effect, how does it affect the residential market? Well, if these locations are closing, that means jobs are changing or jobs are being lost. Corporations are downsizing. Corporations aren't hiring as much. They're cutting hours, the whole bit. So it's trickled down. So eventually, people will suffer on their income, which eventually will suffer on their own private, personal mortgage payments. So this is just another sign, another thing that's going to push everything over the edge. We're going to have multiple collapse of real estate in different sectors here. So, as you know, things are happening. I mean, I'm busy. I'm busy beyond belief, and we're growing, and we're trying to do as many deals as possible, and we're having a fun time doing this. So, as you know, I do offer training programs and partnerships, and this is what we're focusing on now. Top 10 ways to earn income and build wealth during the housing correction, housing crash. From all these things, I just talked to our attorney about foreclosure auctions, talking to our contacts about the bank-owned REOs, working short sales and short payoffs, taking properties over subject to, looking at HOA and condo association foreclosures. I got a call with somebody after this video on that, looking at people not paying their property taxes and doing tax deed foreclosures. Probate and estate foreclosures are picking up. More zombie properties out there. Look for the blue tarps on the roofs. Underinsured. We're having insurance issues now with lots of different providers that are hurting homeowners, and surplus overage with respect to what happens in foreclosure auctions. So if you want to know all that information, we're involved in all those things, plus this new concept called novations. Definitely want to reach out to me. I can talk to you about it. You can jump on our training. I'm going to be launching a new training course with all this in it very shortly. So reach out to me, guys. If you can find my email on the video, you can just reach me from there. And by the way, as I said, if you're in the Tampa Bay area, please, go to the Eventbrite link down there. Text me, email me. I'll send you the link if you want. Love to have you at our event. Basically, it's really a launch party for our new real estate brokerage, but we're really going to be focusing on the investor community and really talking about and doing the things on a larger scale that I just mentioned on that previous slide. So this is how you participate in the real estate market. 8% mortgage rates aren't going to cut it. Price points really haven't come down to compensate for that. The Fed really isn't dropping interest rates anytime soon. Yeah, there's maybe some recent movement on mortgage rates, but the Fed is holding pat for quite some time now into 2024. So if you're looking to buy a cheaper place to live in, or another location, something to invest in, etc., make your money work for you, connect with me. I'll take you through the process, and you can see if what we do makes sense for you. All right, guys, so I hope to see you at the launch party if you're local to Tampa. Other than that, hey, I appreciate the views, the likes, and the comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to speaking with you in a couple of days. Take care.